Monday, the 4th of December. Welcome. Good morning, everybody. I'm Guy Johnson. Joining us in less than an hour is our guest host today, Emily Sanders, the CEO of Sanders Financial Management. Now, today's guest, Emily Sanders. She's our guest host today, CEO and President of Sanders Financial Management. Emily thinks the inverted yield curve is mis-signalling the prospects of an imminent rate cut by the Fed and expects one hike at the start of next year to ward off inflation. In the equity arena, she sees the Dow falling from its all-time highs by year end and expects Europe to continue outperforming the US. Emily, great to see you on this side of the pond. Thank you very much for being with us this morning. Let's start off with the big picture stuff. The dollar, it's clearly coming under pressure. We've recognized that over the last week. Everybody's been waiting for it. How does it change the game for the Fed? Presumably it increases the threat of inflation.
Well, the Fed is really in a quandary because its main concern is combating inflation, and there have been wage pressures and so on. And Ben Bernanke has been talking about those, as well as Michael Moskow, the Chicago Fed chairman. So the market, the bond market, really wants to see the Fed ease, and they've been through their actions, pushing for rate cuts, which is why the yield curve is inverted. But the Fed is saying, no, inflation is still a threat. So there's really a battle going on between the Fed and the bond market.
Which is stronger? Because the dollar's move as well would seem to indicate that the market doesn't believe the Fed. The market clearly believes the situation is much worse than the Fed is recognizing, and the Fed needs to cut rates. Who wins this battle?
Well, in my opinion, the Fed does, and we're looking for a quarter-point rate rise in the first quarter of 2007, and that seems to be the prevailing wisdom right now, as well as Bernanke's talking about the economy is really not so bad, it's improving. Yes, housing is weak, but all the other sectors are pretty much okay and firing on all cylinders.
Doesn't the Fed have to do this? Doesn't the Fed have to sort of talk the hawkish talk for a little longer than actually it thinks the hawkish talk, as it were, because it needs to keep this market at sub-trend, keep the economy at sub-trend growth for a little bit longer, and inflation's a kind of rear-view mirror metric, and it sort of needs to keep going, and then it can change when it actually sees the momentum really turning. So the market signals early, the Fed signals late. Somewhere in the middle, we're going to get a change, and the question is, where is that point?
Well, it's a similar analogy with the ECB, because the ECB is talking hawkish as well, but actually inflation is below trend in the Eurozone and slightly above trend or at trend in the US. So the Fed really does have to be vigilant, and with Paulson going to Beijing next week, the whole trade imbalance question is really weighing heavily on the dollar.
Emily, let's leave it there. It's a good introduction. We'll start with the macro. We'll get to the micro. We're going to talk about stocks a little bit later on as well. We'll talk about how you should be positioning your money in the equity space. Emily Sanders, CEO of Sanders Financial Management. She's going to be with us for the next couple of hours. Right, so let's get back to our guest host now. Emily Sanders is the CEO of Sanders Financial Management. Emily, we've talked about some of the big picture stuff. How do you rate the markets right now, the equity markets?
Well, the equity markets are looking great, really better than we expected when we were last here a few months ago. So with the Dow, the S&P, and nearly the NASDAQ up double digits for the year, we think there'll be a slight pullback in December and still end up the year quite healthy.
What about 2007?
Well, 2007, we're projecting just a high single-digit return. And, of course, the world economic picture is very healthy, more so than it's been in a long time. Eurozone is looking great, and, some of the BRIC countries are, I guess the risk factors are mitigating. So, really, international investing is a place to be.
International investing, you've got European stocks trading on sort of multiple of 16, 17. You've got US stocks trading on 22, 23. Do European stocks look cheap in your mind?
I wouldn't say cheap, but they do look to be a better place to put one's capital than U.S. stocks. And also being a U.S. investor, we get the added boost of currency appreciation, which means that in U.S. dollar terms, the European markets have actually provided a higher return than for the Europeans buying their own European stocks.
You mentioned Asia a couple of times actually already this morning.
Yes.
The Nikkei has massively underperformed this year, being probably the biggest disappointment in many people's portfolios. Do you think actually the fundamentals for Tokyo look better and you're going to start to see a turn? The last couple of weeks it's outperformed. Could we see an extension of that?
We're really not looking for that in Tokyo. China is just far eclipsing and growing what Japan is. Think back to the 1980s when Japan was everyone's darling. It really hasn't been there since. And at this point now, China is number 2 in the world of R&D expenditures after the U.S. in a recently released OECD report. So we're not putting too much stock in the Japanese market.
But the Japanese market has sold down this year. The Chinese market has just been going in one direction, and that's been upwards very aggressively. Relatively, do you think, because Japan benefits from the China story, relatively, you don't think there's any value in what is happening in Japan right now versus what's happening in Shanghai and Hong Kong?
Again, not to insult the Japanese, but it just seems like a stagnant market.
Right.
And even though it's mature and the infrastructure is there, the Chinese are not going to let their economy falter before the 2008 Showcase Olympics. So all systems are go. The Chinese are expanding into Africa, Latin America, countries that no one else wants to touch,
yep.
And the Chinese are there. So it is still a very export-driven economy, and the internal demand that some of the previous guests were looking for hasn't quite materialized yet, but they'll catch up very, very quickly.
A few minutes left here on Squawk Box, and we'll continue our conversation now and wrap it up with Emily Sanders, CEO of Sanders Financial Management. Emily, Ross was just mentioning London and what's happening in London, and the arrival of the super wealthy in the capital really had an impact on property prices. What are you advising your clients in terms of how to play the real estate story?
We're advising our clients, Guy, to allocate at least 10% of a well-diversified portfolio to REITs. And there are many, many REITs in the United States, and at the moment the commercial real estate is definitely on an upswing, even though it's well documented that the housing market, residential, is nearly in a recession, that there's so much capital sloshing around that the commercial real estate market is just booming.
Why the United States? Why not Europe or elsewhere?
We also like international real estate, global, and there are a lot of spots around the world, particularly in developing markets, where real estate is undervalued and the super rich are buying vacation homes or investment properties. So
the asset story continues. This assets inflation theme that we've been watching over the last few years, it's not done yet.
Not done at all. And of course, with the advent of global travel and global communications, it's not as outlandish now to have properties all over the world.
How has the diversification story, because 5 years ago you'd have been coming in here and we'd have been talking about equities and bonds, and that was pretty much it. Now we've got all kinds of other assets that we're watching. Like, for instance, how do you advise people on commodities? How has this diversification play changed your job and the way that clients also are perceiving how they should manage their portfolios?
Well, last month we set up a new asset category in our investment policy statements for clients called real estate. So now there's no longer just stocks, bonds, and cash. There's also real estate as a focus asset class.
What about commodities?
Well, commodities are in there, but we don't feel at this point that they're big enough to carve out as their own separate asset class, but we definitely do favor the rise in commodities fueled by China and India as an investment theme for our clients.
Well, let's talk about the emerging markets. How do you see those?
Well, India, China, particularly India, I mean, growing 9.2% GDP, almost getting overheated. Really, it's a great story. And even though the infrastructure is very weak in India, that creates even more potential for riding it, you know, with the 1 billion plus people. And they do have more of a consumer economy at this point than China does.
Would you be putting money into the Indian stock market at this stage? Like, it's pretty toppy.
Well, it is, but we still
said that before, though.
We still see more upside.
Right. Emily, That's a good point to leave it on. Thank you very much indeed. It's been great to see you this morning. Thank you very much indeed for your time.
Thank you, guys.
Emily Sanders joining us from her company, eponymous company, I guess you could call it, Sanders Financial Management. Right, Worldwide Exchange is up next, but it's a big day for us here on CNBC. We are launching CNBC.com. That means all of our email addresses are changing now. That's going to be extremely useful to you. You need to know that piece of information because our guest host tomorrow, Steve Forbes, Editor-in-Chief at Forbes magazine. It's going to be a fantastic show. We'll look forward to having you along for the ride. We'll be back bright and early tomorrow morning. Worldwide Exchange, though, coming up next.